All right, let's dive into a really powerful tool that tries to solve one of the biggest challenges in trading. How do you spot a major market turn before it actually happens? It's called the Fisher transform, and honestly, it might just change the way you look at your charts.
This is the million-dollar question, isn't it? We all want to nail that timing. Get in right before a stock takes off and get out right before it tumbles. But how on earth do you do that consistently?
Well, a big part of the problem is that a lot of the tools we use, like moving averages, are what we call lagging indicators. They're great for confirming a trend, but only after it's already well underway. What we're all really searching for is a leading indicator, something that gives you a heads up before the change. And that's exactly what the Fisher transform aims to do.
So enter the Fisher transform. It was created by an engineer named John Ehlers, who specifically designed it to tackle this exact problem of market timing, aiming for clearer and, crucially, earlier signals.
So how does it work? Well, the secret sauce comes from statistics. It uses something called a Gaussian normal distribution, which you probably know as the classic bell curve. And the whole idea is pretty simple. In any data set, most of the values are going to be clumped around the middle, right? The really extreme highs and lows, those are the rare outliers.
And this is where the genius of it comes in. The Fisher transform takes all that messy, chaotic price data and basically forces it to fit into that nice, neat bell curve. It brings order to the chaos. And by doing that, the truly extreme price moves, those potential turning points, suddenly pop out and become way easier to spot. Now, we're not going to get bogged down in the complex math here, but here's the gist of it in 3 steps. First, it takes recent prices and normalizes them, squishing them into a range between -1 and +1. Then it uses a logarithm to really amplify the values at the far ends of that range. And what you get at the end is the super responsive Fisher transform line on your chart. So when you actually plot this on your screen, you're going to see 2 lines. You have the main Fisher line, which is the fast one, and then a second slower line that we call the trigger or signal line. It's really the interplay between these 2 lines that gives us our trading signals.
Okay, so how do we turn these lines into something we can actually trade? There are really 3 key signals you want to be on the lookout for. Let's break them down one by one. First up, the most common and straightforward one, a crossover. It's simple. When that fast Fisher line crosses above the slower trigger line, that's your potential buy signal. And when it crosses below, that's your potential sell signal. Nice and clean. Now, here's where that whole bell curve idea really starts to pay off. Because the data's been normalized, those extreme readings become really significant. When the Fisher line shoots way up, it can signal that a market is overbought and maybe due for a pullback. And on the flip side, when it dives way down, it can signal an oversold market that could be ready to bounce. And this one is a bit more subtle, but man, is it powerful. Divergence is when the price and the indicator start telling you 2 different stories. So imagine the stock price is pushing up to a brand new high, but at the same time, the Fisher transform is making a lower high. That's a classic bearish divergence. It's a huge warning sign that the momentum is fading and a reversal might be just around the corner. Okay, so the theory is fantastic, right? The signals make perfect sense. But let's get down to brass tacks. The question we all want to know is, how does this thing actually perform in the real world? Well, check this out. This is a backtest of a simple strategy using the Fisher transform on the S&P 500. A 76% win rate over almost 100 trades is pretty impressive. But what's really interesting to me is that time and market number, only 8%. That tells you this strategy is super selective. It's not trying to trade all the time. It's designed to keep you on the sidelines and only jump in for very specific moves. But look, no indicator is a magic bullet. The Fisher transform is fantastic at giving you early signals when the market is clearly trending. Its biggest weakness, though, is in choppy sideways markets. That's when you can get a bunch of false signals, what traders call whipsaws, where it's telling you to buy, then sell, then buy again with nothing really happening. So it's a powerful tool, but it's definitely not a magic wand. And that brings us to the single most important rule to remember when you're using this, or frankly, any technical indicator. And here it is. You should never use it by itself. Think of a signal from the Fisher transform as a really strong clue, but not a command to trade. It becomes so much more reliable when you wait for confirmation from other tools. Maybe it's a trend line, a key support level, or a spike in volume. This quote really just nails it. The Fisher transform is an absolutely brilliant tool, but it's just one piece of a much larger puzzle.
Real success comes from being able to take the clues it gives you and fit them into a bigger picture of what the market is actually doing. So, in the end, is the Fisher transform a crystal ball that's going to predict the future with 100% certainty? No, of course not. A much better way to think of it is as a sharper lens. It's a tool that helps you filter out all the market noise and brings those potential turning points into much, much clearer focus. And for any trader, that kind of clarity is a priceless edge.